pensions can often be overlooked as just a long-term, inaccessible retirement plan, when the reality is that pensions are a fantastic financial planning tool, allowing you to invest in yourselves, your staff, and accelerate growth in your business in a cost-effective and tax-efficient way. Today we've got 3 speakers for you. We've got, first off, Nathan Bridgeman from Westbridge Group, explaining all things SAS or small self-administered scheme pensions. We've got Darren Willoughby from 2XL Commercial Finance, explaining the principles of lending to a pension scheme. And Furnley House's own Stefan Fura, discussing as financial advisors how we also practice what we preach to clients and have utilised pensions for our own property purchase and growth. If we've got any questions, if we could use the online messaging tool, and then we'll pick these up at the end of the presentation. And assuming that's okay, I'll pass over to Nathan for us to kick off. Over to you, Nathan.
Thank you, John. Good afternoon, everyone. I'm Nathan Bridgeman, Director of Westbridge SAS, and I'm going to talk through today small self-administered schemes, or SASs. If we can flick to the next slide, please. So as an agenda, I've got just 10 slides for you. So it's very much a brief overview to give you a bit of a flavour of what a SAS is, how it can be used, and then hopefully a couple of ideas revolving around commercial property and loan backs, which allow you for your business to partner with your pension scheme and genuinely use the funds within your pension scheme to invest in your business. So I'll talk through that a little bit, but it is only a flavour. Obviously, there's a lot more detail, and every property or every loan back is individual and bespoke to the directors of a business. Hopefully, there'll be something in there useful that you can take away, or we can pick up on afterwards or in the future. To my mind, SASs are the most underused tax wrapper for business owners. They've been around actually since 1973, really tried and tested, really robust, not contentious, but very, very much underused by the financial services industry. Next slide, please. So just a quick slide on who Westbridge are. We're not a household name, obviously. We're originally called Obsidian Pension Administration Limited. We've recently gone through a rebrand. Our offices are in Leicester by the Cathedral, and funnily enough, they're owned by our SAS, the directors SAS. So we practice what we preach here. Collectively, the 4 owners and directors of Westbridge SAS have got over 100 years of experience in SASs. We don't have any conflict of interests. SASs are what we do. That's all we do. We don't have any other products. So we purely are scheme administrators and professional trustees for SASs, which simply means that we keep you compliant with HMRC rules, the pension regulator rules, and we run the ongoing administration of these pension schemes for owner-managed businesses. At the moment, we're disrupting the market because we've launched a SAS with a unique fee model to get away from the menu of charges where you have pages and pages and pages of charges or time cost. And that single all-inclusive fee, to my mind, is the only one out there in the industry. We're always looking to add value and look to give the best scenarios and solutions for clients. Next slide, please. So just quickly, what is a SAS? Well, a SAS is an occupational scheme, predominantly for limited companies, for directors of limited companies, work really well in family businesses, small, medium enterprises. They offer control, flexibility, and as I've said, the ability for your business to genuinely partner with your pension scheme. So the commercial property and loan back are the 2 most popular reasons why you would use a SAS: to lend money to your business from the pension schemes, pooling your pots together, lending money to the business, or pooling your pension pots together as a business and buying a commercial property. And that can be a commercial property you already own or buying a commercial property from a third party. The other area that SASs are really popular with is family wealth trusts. So it's a really good way for directors of a business to pass assets down the generations to family members, so that a property, for example, can be retained within a trust, passed down the generations, so children and even grandchildren can benefit from the rental income and keep it sheltered from tax. That's capital gains tax, inheritance tax, and transactional charges. So it can run down the generations forever. So we've got SASs that were set up in the 70s that are now second, third generation. Go to the next slide, please. So what is a SAS and the legal structure of it? Well, it's its own separate legal entity registered with HMRC under the jurisdiction of the pension regulator. A SAS is a common trust. The small bit relates to there can be no more than 11 members, so 11 members maximum. Every scheme's approved and every member has to be a member trustee, so you have to be 18 to join a SAS. The role of Westbridge in all of this, of course, as scheme administrator and professional trustee, which is really important, is we've got the liability for any tax charges and compliance with HMRC, so scheme sanction charges, unauthorised payments, late payment fees. They're our liability. We have our neck on the block, both with the regulator and HMRC. Can I have the next slide, please? So why SAS? Here's just a kind of flavour of, the control, the liquidity, the access that you can have. And, if we pick out just a couple of these, I don't propose to go through all of these, but if we pick out something like the liquidity element, which is, schemes don't have to have individual contributions earmarked. Older members can draw on the liquid assets of the scheme. So if you've got something like a commercial property in there, or stocks and shares, dividends and rental income, older members can draw on those and younger members can stay invested. If you have other structures that are earmarked, you might have to sell a perfectly good asset to pay your tax-free cash or produce income when you go into income drawdown. A SAS is only one scheme, so rather than operating, for example, a group of SIPs, individual SIPs, a SAS only has one scheme administration charge, one trustee charge, one conveyancing charge, one arrangement fee if you're borrowing, and therefore it's often more cost effective to run one scheme rather than multiple schemes all linked together. Have the next slide, please. So some of the areas that we get involved with, obviously new schemes establishments to be able to buy commercial property or to lend money to the business. So we establish and do the ongoing running of those schemes. SAS takeovers, if you've got an existing SAS or an old EPP with one of the insurance companies, we can take over the running of that and rescue orphan SASs and do conversions of DB SASs to money purchase SASs. So that's the areas that we get involved with in just that. So if it's SAS, I think that, it's worth just giving us the chance to talk it through and look at the individual scenario because they are all different. Next slide, please. So one of the most popular areas that SASs are used for are directors of a business putting all their pension transfers together in one SAS, consolidating into one pot and buying a commercial property. And when we talk about commercial property, we're talking about land, we're talking about, in the picture here, it's a football stadium that's owned by a pension scheme, but it can be anything from Baptist churches to golf courses to bluebell woods to car parks to pubs, guest houses, care homes, prisons even, and zoos. It can be absolutely anything that is classified as commercial. So what is commercial? It's basically not residential, not something that is habitable as a residential dwelling. Can you grab the next slide, please? So the rules on commercial property are you can buy any commercial property or land within a SAS, and you can borrow up to 50% of the net scheme assets. So if you've got £250,000 collectively in your SAS, you can borrow £125,000. So you've got £375,000 of purchasing power. You can also do part purchase. So a SAS can co-own with a business or an individual, a separate legal entity. So you don't have to have the whole of the property or land within the SAS. You can also do phased property purchase. And there's some quite clever stuff we can do with stamp duty on that and planning there. Connected purchase is really important because what it means for the sake of business funding is if you already own a commercial property that's outside of the pension scheme, so it's on your own personal balance sheet or owned within your business, is a good opportunity to sell it to your pension scheme. This does two things. It obviously releases all of the cash out of the pension scheme to the business or to you as directors of a business. So you've got an immediate exchange of property to the pension scheme for cash. But what it will also do is shelter the property or the land long term in a SAS wrapper. And what does that mean? It means it's sheltered from income tax, capital gains tax, inheritance tax, and transaction charges. It can stay within this trust forever and pass down the generations. So it's often a good idea to look at whether it's worth selling part or all of a commercial property to a SAS to release cash to you or your business. With everything I talk about, everything's within HMRC rules. Everything has to be at an arm's length valuation, so on commercial terms. So with a connected party transaction, if it's your own property that you're selling to your pension scheme, we'll need a RICS qualified surveyor to give a red book valuation, a capital and a rental valuation. Land can be bought as well, and residential, you can't have residential, and the definition of that is that the man in the street can't live in it, so you can't connect the utilities, you can't have the gas, the water and the electric connected. One of the benefits of using a SAS is obviously you can opt to tax. So if you're doing development work, if you're renovating, the materials and the invoices from the trades, the VAT can be reclaimed by the SAS just as you could with a business. So you can opt to tax to get the VAT back. So commercial property, selling a commercial property to your SAS to release cash to the business is very popular right now, especially with the banks putting in so many hurdles, sometimes making it quite difficult to lend. This can be a really, really quick solution to getting substantial amount of money into business owners' hands. Can we get the next slide, please? So on to loan backs. Loan backs are unique to SASs. No other pension scheme can do a loan back. So SIPs, for example, the retail equivalent of SASs can't do this. So loan backs are a really, really useful tool. And I think one of them, I said SASs earlier, were probably the most underused tax wrapper. I believe loan backs are probably the most underused tool within a SAS on two levels. One, it can produce a really good return for your pension scheme, well over and above a trustee bank account or deposit. But equally, it's a really, really good way of lending money from your pension scheme to your business. So the rules are here on this slide. 50% of net scheme assets can be lent. So go back to that £250,000 pension pot. A loan of up to £125,000 can be made to your business, your sponsoring employer of the SAS. Has to be secured. So it has to be to the value of the loan and the interest over the term, maximum 5-year term, equal capital and interest repayments, and the current interest rate, minimum interest rate, is 1.25%. There is no maximum interest rate. So if you wanted to set a rate of 6%, it's getting money out of a business, extracting the money out of a business because it's making repayments at 6%, reducing corporation tax, and that money is going into a gross fund. You're paying your own pension scheme rather than paying a bank. So you're paying the money back into your own hands. So it's virtually a circle, genuinely partnering your pension scheme with your business. The next slide, please. One of the things we help advisors and professional connections with is reviewing their clients' pension scheme arrangements. So whatever that arrangement is, whether it's a group SIP, an executive pension, or a defined benefit SAS, a normal SAS, any of these types of arrangement, family pension trusts, we can review it just by looking at the last annual valuation review, what assets are in the scheme, and the trusteedom scheme rules, and we can see if we can save you money, improve service, or restructure for you. So we have a free director's pension review if you would like, in conjunction with Furnley House, to utilise that service. The next slide, please. And this is the final slide, and to summarise before I pass on to John and Darren. Themes and ideas for clients. So the commercial property sale to the pension scheme releases money to the business or the business owners. The ability to pass assets down generations once in the SAS is genuinely a family wealth trust. The use of pooling resources and lending money to your business, so getting all of your old pension pots together, getting them into a SAS, and utilising the loan back facility or pension-led funding, as you may have seen it referred to, and the ability to restructure old schemes. So any questions, please put them through to us, and I will be happy to take those now or at a later date. And I think I'm passing back to John.
Thanks, Nathan. I've seen a couple of questions coming through online already, so we'll pick those up at the end, but that's great. Pass over to Darren now at 2XL.
Hi there, I'm Darren Willoughby, Managing Director at 2XL Commercial Finance. We have been lending in the commercial marketplace for the best part of 15 years now, and last year just placed just over 76 million of commercial lending. As MD of the business, I've had a particular specialism over the last 10 years in looking at facilities for pension schemes to borrow for the types of scenarios that Nathan was discussing there. Now, obviously it's quite a complex area and the technical terms will all be done by Nathan and the rest of the team. But in terms of focusing on what are the actual core principles of lending to a pension scheme, these are as follows. So the first one being loan to value. Now, because the loan to value is restricted to 50% of the pension fund value, lenders like to lend to these types of schemes. It's relatively low, well, very low risk as far as the banks are concerned, and as such, banks would like to support, which given the current crisis that we are in at the moment, and with banks being slightly reluctant to lend, these are seen as a good bet as far as the banks are concerned, and also then for potential borrowers. The second thing that lenders look at is the serviceability of the possible debt. So what they would look at would be the market rent that's being payable from the building that's been purchased back to the pension scheme. So if those, given that the loan to value is at such a low level, often the market rent does cover the loan, and as such, serviceability is proven. The third part that lenders look at, is, as I allude to there, is tenant quality. And that varies whether that is you are renting that back to yourself or your own company, should I say, or you are looking at a third party covenant. And in that instance, I will paint the two scenarios for you. Next slide, please. Okay, so as I alluded to, lenders look at the quality of the tenant. So in that instance, you might have a scenario where if you are renting back to, say, Tesco's supermarket, clearly they would be seen as a blue chip covenant, and as such would be looked at by lenders as being a good bet, so to speak. If you are looking at renting to a third party, so let's just say you are lending to a hairdressing salon, or perhaps in particular in this pandemic that we find ourselves in, somebody within the hospitality sector, clearly the lenders will grade the quality of the covenant when assessing whether to grant a loan facility or not. In instances where people are lending back to their own, renting back to their own business, clearly there's some due diligence that will be undertaken there around the financial performance of the business. Okay, so whilst you will always have the option to do all of these things and purchase assets through the pension scheme, each case is assessed on its own merits. Okay, the second part is business performance. So if you are looking at renting back to your own company, then the way that the lenders would be looking at potentially the last 3 years' accounts, just to demonstrate that the business has enough cash and profit within the business that can pay the market rent up to the scheme. Okay, if the business is currently loss making and can't demonstrate that it can afford to repay the debt, then lenders will be reluctant to lend in the same way they would on any type of transaction. They would look at clearly the financial accounts, as I alluded to, when making that assessment. They would also consider sector. So in terms of looking at certain sectors that will be hot at the moment, so industrial is something that banks are keen to support. They would obviously consider office if it's an owner-occupier element to it. And really the sectors that would come under a bit more scrutiny at the moment would clearly be things like hospitality, where we've got several closures around national closures in those particular sectors. Serviceability, as alluded to, here we go, correct slide, I think. Serviceability is demonstrated by the accounts or by the rent, and clients will, banks will clearly look at the experience of the individuals that are trading and running those businesses that are potentially going to be tenants. So an example of this would be if you are renting back to your own company, and that company has been established for 20 odd years, you've got respected, experienced directors at the helm, lenders are going to want to try and support. If you are renting to a established let's use a hairdresser's for an example, that's only been established a year, uncertain track record, no financial accounts, then clearly lenders would take a different view on that. Okay. Lenders would also consider the location of the asset. They would also look at background wealth of the individuals. Now, clearly, background wealth, a lot of you might say, well, what's that got to do with it? A pension scheme is a completely ring-fenced asset. That's true. But what they would need to be able to demonstrate is that the client's business, that they can generate sufficient profit in order to meet their own personal and household expenditure, so that there is enough money left within the scheme to be able to service the rent, which subsequently goes up the line to service the debt. Okay. Lease length, easier probably to give examples here. If I'm renting back to, we'll use Sainsbury's this time, and Sainsbury's have got a 10-year lease in place, for example, then there's more security of tenure there. If the lease is 2 or 3 years with a break after 18 months, clearly lenders will take a different attitude towards that. So in terms of lease length, the longer lease would be most beneficial, and also with minimum breaks. Last but not least, loan amounts and security. Generally speaking, the more that you look to borrow using the scheme, you are likely to get better interest rates. So the more you borrow, there seems to be a fall in rates. And security, lenders would always look to take a first legal charge over the asset that you're either looking to purchase or that you're looking to raise capital off. Okay. Next slide, please. So, as I alluded to here, you would look at 2 different types of potential borrower. So you would have a commercial owner-occupier. So this is where the pension scheme buys an asset and then rents it back to that person's own business. And in reality, a large proportion of transactions fall under that sector. And the way that a lender would assess it, again, would be on the financial performance of that business. So typically, they'd look at the last 3 years' accounts, prove that the directors can raise, that can meet their own expenditure, and that there'd be enough cash left in the business to meet the rent. Okay. The second element is commercial investors. So this is where you've actually got a third-party tenant. So clearly, you can't go into as much financial due diligence as perhaps a lender would like to see, because it would be unfair in the majority of cases to go out and ask a tenant to produce financial information to back up your ability to borrow money. So whilst lenders will do an element of financial due diligence, I think a lot of the onus would fall on the potential borrower themselves to make sure that the tenant that they are putting in their potential building is of sufficient quality, and secondly, that that business will make enough money in order to service the debt. Okay. Next slide, please. So in this case, the commercial owner-occupier element, as I said, they buy the commercial premises and then they would look to rent back to their own company. A lease would be created at market rent between the pension scheme and the individual company. And serviceability of that debt is based on the market rent. So let's say, for example, that the loan repayment is £10,000 a year and the market rent is £20,000 a year. then clearly it can demonstrate that it can afford to service the debt. What you can't do is fudge that figure. You can't say that the loan repayment is £10,000 a year, the market rent is 12, but actually artificially inflate it so that it can meet the debt. It has to be done by a rich chartered surveyor, and the surveyor would have to comment on the rent that should be payable. Okay. The other thing that the banks look to do is stress test the loan serviceability calculation. So at the moment, we're all benefiting from low interest rates. Some lenders would artificially inflate the base rate just to prove that should interest rates change in the market, that it can still meet debt service calculations. Okay. And the final bit on that ideally there is some commonality between the directors of the business and the pension scheme. So whilst the perfect scenario from a lending perspective is that you've got director of the company and you've got the beneficiary of the scheme is also the same person. You do have instances where you might have 2 or 3 different people that are the persons within the pension scheme, and the business is different. And as long as we can explore the commercial reasons as to why that's being done, then lenders seem to be particularly receptive to it. Okay. Next slide, please. So again, this is alluded to, as I alluded to before, this is really where you have your commercial investors. So pension scheme buys asset and then rents it to third party. Covenant strength is key. Again, just by comparing the two, if you looked at Sainsbury's or you had Granville's corner shop, for example, they're clearly poles apart in terms of their covenant strength. So lenders would assess this, and in reality, that they will be less likely to lend if the tenant quality isn't as strong. So whilst there's not a great deal of financial due diligence that you can do, lenders will look at that. Next slide, please. So this really is for those that might be in a position where they could introduce clients who are looking at pension scheme borrowing, or looking at, sorry, could you just skip this next slide on, please? We're just one behind on it, if that's possible. On to process. Okay, thank you. So initially, if you or any of your clients are looking at this as a possible solution, simplest thing to do would be to call or drop me a line with your details, and we'll have an initial chat around what the client is looking to do. We would then contact the client to discuss the deal and the possible lend, and then we'd follow that up with an information request based on the specific client's requirements. So again, if it's somebody looking to rent a building to their own business, then we'd be looking at 3 years accounts and 6 months business bank statements initially, and a little bit of data around them as individuals. Upon receipt of that, what we would then look to do is have an initial assessment and client interview over the phone. So that would be really around their background, their story, their business, and then look at the actual transaction itself. So unlike residential lending, where you can get some basic numbers and hit a button, sorry to offend any residential mortgage brokers on here at the moment, and it spits out numbers, it's actually a formal assessment. There's a 10 to 12 page report that has to be written on every single application when looking at submitting these things forward. We would then, having written up that application, send this out to all the different lenders that may be out there in the marketplace. So we give all the lenders an opportunity to quote for the business and pitch to win that business. Clearly, some lenders will have an appetite in some areas and not in others. So it's important to make sure that the deal gets to the right place. Once we've got those lender responses back, we would then present them to you, the client, or your client, and then decide which lender you want to press forward with, and then subsequently would move that forward to full credit approval. And then once we've got to full credit approval, all the relevant documentation will be issued, and then all the parties would be able to liaise to ensure that we get through to completion. And then at that point, once the property transaction is done and completed, 2XL move away, and we leave that to the hands of the rest of the team. Next slide, please. I know we're jumping around on slides, or is it just me? In terms of current rates of borrowing, now I often get asked the question in terms of, oh, what's the rate? What's the best deal out there at the moment? In reality, every deal is different. Every deal is different, and ultimately, lending and lender appetite changes almost on a daily basis. So what we do as part of that process, without appearing to go into sales mode, is really that we'll go out there and make sure that your individual case finds its rightful home, and then you know that as a client that you've got the best possible terms and deal for your individual circumstances, really. A couple of examples that we've done recently. So that's on the next slide. We would look at owner occupier. So we did recently over in Derby, client who was wishing a commercial property agent, wanted to buy their own premises, bought the building, rented it back to their own limited company. Dead straightforward, lease created at market rent, and a fairly straightforward transaction. But we've also done the commercial investment angle. So we've had clients who have bought offices, split those offices up, and then ran them as serviced business centres. So as was previously alluded to, number of different options, number of different types of buildings. And if anyone wants to have a chat on looking at this as an option, then I'll be more than happy to do so. So that's Darren Willoughby, 2XL Commercial Principles of Lending.
Thanks, Darren. That's great. Very useful. If I introduce you now to Stefan Fura at Furnley House, and Stefan can explain how we at Furnley House utilise SAS and pensions to purchase our own property details. So over to you, Steph.
Thanks, John. Yeah, hopefully we can bring together what you've heard from Darren and Nathan to put this in a little bit of context around how we've used SAS to benefit our business over the last 12 months. Well, it's actually going on for almost 2 years now. So first of all, if you don't already know, obviously Furnley House, a financial planning business, but my role as one of the founders of Furnley House is now to run the larger group that we set up last year, and that incorporates two businesses. It incorporates Furnley House, which is a financial planning business, and then Asset Intelligence to support financial advice businesses like Furnley House with investment research on more conventional investments, such as shares and other things that you hold within your pensions. And last year we went on a journey. We were merging these two businesses together to create a larger group, and we had two offices. We had an office in Syston, which we'd outgrown at Furnley House, and then Asset Intelligence had an office in the middle of Leicester, which they also had ambitions to outgrow. And so we were creating this new group. It made sense for us to be under one roof. It made sense for us to have space to continue both of the business's growth plans, and we wanted to try and find the ideal way of doing that. The challenge we had is this was our building in Syston. We've been there for a number of years. Bizarrely, we came up with the name Furnley House, which was our three surnames, and then we found a building actually called Furnley House, although it was spelled differently. So we were quite well connected with the building, and we'd significantly outgrown it, and we needed more space. And so our real issue was, how do we do this? How do we achieve finding more space? How do we do that find the kind of area where we can both grow into? So as I say, Furnley House and Asset Intelligence. But also, how can we do this in a way that is the best way of doing it, the most efficient way of doing it? And we provide advice to clients of ours using both SIPs and SASs to buy commercial property, and we understood that it was a real advantageous route for us to use. And there was a couple of reasons for that. Number one, we really believe in employee ownership. We are privately owned by all of our owners that are working within the group. We have an EMI scheme in place for our staff, and we saw this as a real opportunity for us to to give some of our employees a chance to be an owner of the building that we were going to be occupying. So that was a big attraction for us. Number two, we couldn't find a building that ticked all of our boxes. And so for us, we wanted to take a project on. And so in order to take a project on, we needed to give ourselves the space and time to do that. And if we were buying a premises ourselves within our business, and we were looking at it and looking at what the options are, we really needed to find something that we could move into that there and then. Whereas if we were doing it as a project, because we were investing in that project within our pension, we could take the cost of doing the building work as part of our investment, and therefore wait until the building work was concluded before agreeing a lease between our business and the pension scheme. And that was the real advantage we had, is we weren't therefore pressured to have to be moved in within a rent-free period, or have to rush the work that needed to be done. And so this was the building we found. We really were looking at the potential of the building. So at its core, it didn't have what we needed, but it had the potential to be what we wanted. It was in the right location. It had excellent parking. It had space. It was, it had some interesting potentials for us, but it needed a lot of work, and that meant time. And so from our perspective, what we did is we sat down and we mapped out, look, we could buy it for a reasonable sum of money. We could then put a budget together to do the building work for the plans that we wanted from it. We could complete that building work, which in turn would increase the capital value of the building, but it would also improve the rental value of the building. And then we could already almost pre-agree with our own business that we were then going to take over the tenancy at that new improved rental value. So for us as investors, we could justify the investment that was required in upgrading this building and improving it, because we knew we had a tenant ready to take it on at the end of that process, which was our own business. And so what we did is we got together. We ended up choosing to use a SaaS. Again, as I mentioned, we could use a SIP or a SaaS, but the idea for us, and the benefits for us in using a SaaS, was there were 11 of us, and so a SaaS was more cost effective than the SIP. It was straightforward because this would be the only asset within the SaaS. And in addition, we did see there could be opportunities in the future to benefit from using that loan back that Nathan talked about. And as it's transpired, that's something we are now utilising, which I'll come back to. So for us, that was why we went down the SaaS route. And when we sit down with clients, that's always the first decision. Is it a SIP or is it a SaaS? And there are pros and cons for each. And we have to, when you have an advisor can sit down with you and look at those options. In addition, with financial advisors, we have a really good group pension scheme in the background, which we're all members of. We have our own investments within those pensions. So for us, this was about complementing what we've got and about taking some of our individual pensions and putting it into this different asset, this different diversified approach. And so again, that's where the SaaS became beneficial for us, because we all continue to remain to have pensions in the background, and that's helped us with keeping this very simple. So as it transpired, what we did is we all put varying amounts of money into this SaaS. 5 of the members are significant shareholders within the business, and the other 6 members are employees within the business. And so that's what we did. You'll see that the project was quite large. We gave ourselves a time frame. We bought it in February. We gave ourselves an objective of being ready to be in the building by Christmas, which we achieved. It was tight towards the end, but we achieved it. And again, we were able to set a longer term view. And I know that by doing that, we were able to really shop around and get the best partner in Corbus who helped do all the work for us. And that had benefits on the amount we spent on the project. I think if we'd have been under pressure as a tenant moving into it, or even if we were buying it in our business, I don't think we could have took the same long-term view on it. And I think that would have pushed up the build cost. I think it would have heightened pressure and stress at the time. And equally, when you're trying to bring 2 businesses in at the same time, it gave us that bit of time to really plan that, how we did that. And so we conducted a renovation. We took it right back to brick, and indeed left some of that brick exposed. And we did a lot of work on it. It was very much a labour of love. We discovered all sorts of hidden potential in the building, new roof lights that we were covered up, that we exposed. We created our own bar upstairs and roof terrace, and we really saw the potential of the building. And I think what we did is we basically created our ideal building. We couldn't find one, so we made one ourselves, and that's what the pension scheme has enabled us to do. And I mentioned that when we then concluded this, we moved in. We completed it December the 20th, the day of our Christmas party, which we actually held in our own bar area upstairs, which was great. And then we all moved in properly, ready for the start of this year. But at the same time, our group is looking to continue to expand. We are looking to acquire other advisory businesses, and that's something we've been active in. And for us, what's happened over this year, we've seen with the corona and the challenges of the coronavirus, is that yes, there is lots of support for lending with businesses that are maybe struggling and need a bit of help. But businesses like ours that are wanting to continue growing and continue doing what we're doing, it's challenging to create that kind of what I would term growth funding. And so for us, having this pension scheme in place and having this SAS has opened up another opportunity for us. And that is that we've been able to actually agree an arrangement with our pension where we are to borrow some money, the excess cash we have left in this pension, borrow some of that money and lend it to our business, for our business to be able to utilise that towards acquiring more businesses. Now, for us, that's again a great solution, because it's really easy. It's been really easy for us to do this. As investors, we not only now have the rental income coming from the building, but we also have the interest coming from the loan that we are making. We have been able to support our business, which in turn strengthens our business, which in turn is also the tenant paying the income on the building. The lease we have negotiated is a lease which is got review points in there to continue reviewing that rent, and we hope be in a position to increase that rent. So it's very much a perpetual circle that we've been able to support our business utilising this solution. So again, when we summarise that and look at that, we can say that as investors, we've benefited because we've bought a building with potential, and we now have been able to increase the value of that building by greater than the cost of the building work that we've done, which we're really pleased with, considering that commercial property has been under a lot of pressure this year due to the changes that coronavirus has brought on. We have a yield going into our pension. We also, at the start of this coronavirus period, we weren't sure as a business what it would mean to us, and thankfully we've been able to navigate this process relatively unscathed. However, we weren't sure at that time, and like most businesses, we were sitting down and having sensible conversations around what we were going to do with cash flow, employees, whether we would be utilising the furlough scheme or not, and all those conversations were taking place. But because we still remained the tenant, the landlord of our own building, we were immediately, if we wanted to, able to say, well, actually, we could give a 3-month rent-free period or a holiday on the rent. We were still sitting on both sides of the fence. So although with a landlord and with a tenant, we have to keep that at arm's length, but we had that ability to have discussions about that if it was needed. We've been able to ensure that, as investors, we're seeing a good yield, where other investments have obviously been very volatile. We've been able to utilise our pension to lend to our business to continue doing acquisitions, which is what we want to continue doing. We haven't made any borrowing within the pension, so this is all cash within the pension scheme that we've put in. But we're always able to do that should we wish. And the times we may want to do that in the future is if we might want to buy another property somewhere else. If one of our members was looking to maybe take benefits because they were in retirement and we wanted to create the cash to be able to provide that, we could use borrowing. we could even use borrowing within the pension scheme and then immediately lend that money out to our business, because our business probably wouldn't be able to acquire lending at the rates that Darren's quoted for a commercial premises borrowing money versus the growth funding that we're maybe trying to achieve. So there may even be a difference between what we can borrow the money from the bank versus what we may be lending it to ourselves within the business. So there are all sorts of opportunities that the SAS has presented to us, not to mention the fact that we have got 6 of our staff members, in addition to the 5 owners that own part of the building, that have got an increased sense of ownership about our business. And for me, when I look at all the benefits that's delivered to us, it's been a really beneficial experience. So hopefully that helps you put into context some of the stuff that Nathan and Darren have talked about today. And that's our experience at Furnley House.
Great trip back down memory lane, Steph. Thanks for that. Okay, questions. I've got a few questions coming through. So if I read them out, I think first one's probably directed for Darren. How has the pandemic affected SASs and SIPs lending?
I think generally speaking, in terms of the lending market, is clearly more difficult than it was, 6 to 8 months ago. However, given that the things we talked around loan to value and people looking to raise money to either inject in their own business or raising money against their own commercial premises, I would say that it is still the one area that lenders do want to support. And that's why we're seeing an increase of inquiries in this particular area, either to look to acquire or to look to capital raise. So it's very much still an open market as far as that element of it is concerned.
That's good. Has there been an increase in people using their SAS schemes as a cash release? That's probably Nathan, I would say.
Yeah, there certainly has. So we've seen an increase in loan backs since lockdown, and since sort of businesses have obviously needed access to monies. So yeah, we've certainly seen an increase in loan back business.
Nathan, again, can sole traders have a SAS?
The definition from a revenue point of view of a sponsoring employer is a business with an employee. So technically, a sole trader can have a SAS. However, they're going to be restricted in what they can use the SAS for. So, for example, they can't do a loan back because there isn't actually a company to loan the money to. You can't lend the money to a scheme member personally. So in theory, yes, but in reality, they may well be limited. They could buy a commercial property if they have employees, but yeah, so any business, so limited liability partnership, they can sponsor a SAS, but they may be limited in what they can do with it.
Could a SIP or SAS buy a predominantly commercial premises where there is, say, a small residential flat above? Purchase would be outside regulated mortgage lending rules, just conscious that a SIP or a SAS can only own commercial premises. Yeah,
SIP and SAS can only own commercial property, so it couldn't own the residential property. There are some exemptions. So for example, if we use something like a pub which has habitable accommodation, maybe a flat above the pub, if it's the manager of the pub who isn't the member of the SAS occupying it and vacates it on his termination of employment, so in his employment contract it's clearly stated that they're going to leave the flat above the pub, then that would be fine. And there are other examples, caretakers, cottages, things like that. So there are areas where residential elements can be allowed. Farms are another good one. But yeah, on the whole, as a rule of thumb, it's commercial property only. So in that scenario, what we might do is the pension scheme buys the commercial element, the conveyancing lawyer separates out the commercial part. The residential is then bought by either their business or personally. So it's under separate title. Great. And final one that I've got online is, can you transfer existing pension monies into a SIP or SAS where husband and wife are beneficiaries of the new scheme? Yes, you can. So a SAS can receive a transfer from any recognised pension scheme. Yeah. Brilliant. Okay. Hopefully everyone found that useful, informative. Thanks to our 3 speakers today.
As I mentioned earlier, that this has been recorded, so will be available to download and look back at. If any questions or things come up that you'd like to that haven't been answered already, then please get in touch with us at Furnley House, and we'll be able to get in touch with you afterwards. Thanks very much for joining us, and enjoy the rest of your day.
Okay.
Thank you.